you. So,
Okay.
and then how you feeling about where you're at? You feeling good?
Yeah, so I feel great.
Okay, so I thought we'd do the same thing. I thought our session yesterday was great. We did covered a lot of ground in section 2, remember, which was 33 questions. This is section 3. This is 23 questions. So 23 questions in this area, and we're because of your situation where you have more than one provider, we've gone to our source document here, right? This is the source document and what people use to write those books. So, you know, we can know that this is, we're on track and discussing these things. So you're going to get at least a couple questions on orders. And the only order that we have that has no contingency, no qualifier, is a market order. Or I'm telling my broker, I say, listen, I'm more interested in execution than I am price. Let me get a smaller font. You know, somebody was kind of making fun of the way I had said this. I had bought their product, and I said in my review, I said, I'm not sure if there's an easier way to get this, if there's a coupon. And to be honest with you, I wasn't interested in finding out if there was a cheaper way. I just want it, and I want it now, and I want to be able to download it immediately. So that's where you're saying, I want this stock, and whatever the best deal I can, the best available price. Now, the other types of orders we have, let me get that smaller here. The way I think about it is that's one that has no contingency, no qualifier, the market order. But we have another type of contingency we can add to an order where we can tell our broker to stop the loss, You know, part of successful investing is letting the flowers bloom, but more important, pulling the weeds. And so at what point do we want to stop the bleeding? So let's say we buy 1,000 shares of Apple at $154 per share. And I say, Chris, how much are you willing to lose in this position? And you go, gee, why are you sending out negative energy like that? I said, well, you know, it's better to have this discussion now about what point we're going to say we're out of here. And so, you know, what we can do here is test question. We can place a sell stop at maybe 150. And what I'm telling my broker here is that if Apple trades at or through 150, pull the trigger, turn my contingent qualified order into a live market order, and send me home. Now, Chris, here we're going to lose, worst case, approximately $4,000 because we don't know what the next trade is once it becomes live, and that's two separate events, right? And so if it trades out or through, we're watching the tape on CNBC. If we're watching that tape on the bottom of the screen, Chris, and we're watching the Apple trades go by, can't tell you how many customers get confused, and you see a trade of at 150 or you go, that's my trade. I go, no, Chris, that's not your trade. That's the trade that turned your contingent suspended order into a live order. Now you have a live market order. Now, if you want to be foolish, you can pull the trigger and turn it into a limit order, but that would be very foolish because now you're saying you don't want to go home unless you can get your price or better. You say, Dean, what is Apple trading at? I said, well, Apple's trading at 154. And you said, well, Dean, I'm not willing to pay 154. So we also have a limit order where you're saying you want to do business, but at your price or better. So, you know, if Apple's at 154 and you don't want to use a market order, you could say, Dean, let's put in a buy limit at 153. And if we can get Apple today at 153 or less, I'd be willing to do that. So the only order that has no qualifier contingency is a market order. As we said, you're testing tomorrow, so I'm not going to go in all the different permutations of this because that could eat up our entire hour this morning. I would have a general understanding that that buy limit is below the market. So please note, I showed you two examples And let me just get out my thing. In both of the examples I gave you a buy limit. And I gave you a sell stop on Apple. And please note, Chris, I placed those below the current market price. I think a great mnemonic to remember where we place orders in relationship to the current market price is bliss. And that stands for buy limits and sell stops. Remember, we said you could have a sell stop that turns into a market order, or one that turns into a limit order, are placed below the current market price. And remember, that could be a sell stop or a sell stop limit. And we said that would be foolish to turn it into a limit order. Now, from your pre-study, do you know the mnemonic, the memory aid device about orders that go above the market?
This is the chapter that I was having a little trouble on.
Well, good. That's what we're trying to find and fix, right? So
yeah.
So we have this mnemonic device, this memory aid device, and we said at Apple, let's just clean up our little thing here. So let's get this cleaned up. And let's say that Apple right now is at 154. And we know that if we're going to place, or we should know that if we're going to place a order for Apple, not a market order, a buy limit or sell stop, that's going to go below that current market price. And then the mnemonic device we have for orders that go above the market are slobs. And slob stands for sell limits and buy stops go above the current market price. So if what you want to do is sell your Apple and Apple's at 154, you'd put your sell limit above that. And remember, it could be a sell stop or a sell stop limit. Now, the main test point about stop orders, is they are used to stop losses. There's other uses, but for SIE, right? So if you're afraid that the Apple is going to go up, maybe you sold it short. And I say, hey, listen, why don't you put in a buy stop to stop the loss? So buy stops are used to stop losses in short stock positions, and sell stops are used to stop losses in long stock position. You have two positions. You can be long the stock or you can be short the stock. So you call me and say, hey, Dean, what's Apple trading at? I say, Apple's trading at 154. You say, Dean, let's put in a buy limit to buy 1,000 shares at 153 or less. There's always an implied or better. So in other words, if I call you and say, hey, you got it for 152, you should say, oh, that's wonderful. But it doesn't go off today. All orders are considered day orders. So I call you the next day and I say, hey, you want to re-enter your buy limit at 153? I had a client once, in real story, and I was calling him every day. And finally he said, Dean, are you ever going to stop bothering me? I said, no, I'm going to be calling you every day to see if you want to resubmit that order. Now, if you don't want me to bother you every day, test point, you can make it good-til-cancel. So when the customer says good-til-cancel, GTC, you're telling me, Dean, I don't care if we get the Apple today or we get it tomorrow. Anytime you can pick it up for 153 or less, please do so. And, we'll send you a reminder that you have these orders on the books. And then typically April and October, we, say, hey, is this still okay? Because if not, we're going to clean up the order book. I'm a Merrill Lynch broker. And I call you. I say, hey, Chris, have you been following Bank of America, our parent company? I mean, boy, talk about some good things going on. Brian Moynihan, gotta love that guy. And there's a little bit of a bromance between him and Warren Buffett. Berkshire Hathaway owns, over 1 billion shares of Bank of America stock. Woo! And what I think, Chris, is you ought to buy some. And you say, well, Dean, you have discretionary authority on my account. I don't know why you're bothering me. And I said, well, Chris, I can't use my discretionary authority when there's a control relationship. So I'm going to need your permission to proceed. So on your confirmation, Chris, it'll say solicited. That means it was my idea as the Merrill broker. Discretion not exercised, meaning I didn't use my discretionary authority. Now, another example. I say, hey, Chris, I think we should buy these less than investment grade bonds. I think they're going to be upgraded. And you say, well, you didn't have discretionary authority. I said, well, Chris, I'm not comfortable using my discretionary authority in this circumstance. Right. So now if I have discretionary authority, then I just can make a decision. The thing I can make a decision about is action, asset, or amount. A good way to remember this is the 3 A's. If I am going to make a decision as a broker about action, asset, or amount, I need to have discretionary authority on your account. Right. So, be careful on this, right? What I mean by be careful. If the 3 A's are present, then I can go ahead and put in the order, right? So let's try a couple of examples of this. Action means whether to buy or sell the security. Asset means which security to buy or sell. And amount means quantity. What I do not need discretionary authority for is time and price. So, you call me and say, hey, Dean, buy 10,000 shares of XYZ today at whatever time and price you think looks good. So you say, Dean, buy 10,000. It looks like let's put it over here. Time and price doesn't constitute taking discretion. So you say, Dean, buy 10,000 shares of XYZ at whatever time and price you think looks good. Does that require discretionary authority? It does not, right? Because the 3 A's are present. Let's try it again. There's a jumbo CD coming due in my account, Dean. So you call me, say, Dean, there's a jumbo CD, 100 grand. Buy whatever utility stocks you think look good. Well, 2 of the things are present. Action, buy, amount 100, but we're missing the asset. I say, Chris, I don't have discretionary authority on your account. So I need to know what utility stocks we're going to buy. Here's my current recommendations. So 3 A's need to be present. Now, if I have discretionary authority, then that doesn't need to be, right? Now you call me. It's your idea, not me. I'm the broker. I have discretionary authority. And you call me. For example, I had a client. This was my idea, Chris, solicited. I said, hey, Mark, why don't we sell these puts and they expire worthless? We keep the money. And they expired worthless. We got to keep the money. It was about 13,000 bucks. Anyways, then he decides that he wants to sell the 240 puts under the same premise. I go, Mark, these are entirely different scenarios. That's the same thing we did. I go, no, that's not what we did. But, let me walk you through the differences between what we did previously and what you're doing now. I said, Mark, this is your idea. So now that'll look on the confirmation say, discretion not exercised, unsolicited. And what we're saying here, we're just documenting that this is the customer's idea, right? The customer's idea. Now, on the bid and the ask, we're all called broker dealers. We're all called broker dealers. But in any one trade, we're either going to be a broker or we're going to be a dealer. We can't be both in the same trade. Some of us have inventory. And so I say, Chris, at Merrill Lynch, we are a broker dealer. And in some transactions, Chris, we'll be acting in our broker agency capacity. And on your behalf, we're going to get the security elsewhere, and you're going to owe us a commission. But in some transactions, Chris, we actually are a market maker. We have inventory. And we're going to be buying or selling from our inventory. Now, in each and every transaction you do, we will disclose on your confirmation in what capacity we acted. Either our broker capacity, or a dealer capacity. It makes sense that I can't be both in the same trade. How can I represent myself in a negotiation about a markup or a markdown? So, for example, Robinhood doesn't have any inventory. Schwab doesn't have any inventory. Fidelity does not have any inventory. So they're only ever going to be acting in their agency capacity. That means they're going to contact market makers in those over-the-counter securities. And in Fidelity Schwab case, you're going to owe commission. So right now, if the bid is 15, and the ask is 16. The quote is from the dealer's perspective. Now, I think the way to get this right on your SIE exam is whenever a customer is looking at two prices, the customer always pays the high price and always receives the low price. What's that called? The securities industry. This is called my spread. That's how I make my living. So if I'm a market maker in the security, I'll just put my over here. Gamma was my broker dealer back in the day. And so I'm quoting 15, 16 on the security. I'm also going to quote size, how much I'm willing to buy or sell at these prices. So you work at an order entry firm. An order entry firm is a broker dealer that does not have inventory. And you have a customer who wants to buy or sell the security. Right, so it says buy and sell, bid and the ask. And you say, Dean, what's your quote? I say, my quote is 15, 16, 10 by 8. What that means is testable is I'm willing to buy 10 round lots into my inventory at 15. I'm willing to sell 8 round lots out of my inventory at 16. So, you know, what we're saying here is the market maker, dealer principal. This is the price at which the dealer buys. And let's put that in a smaller font. Boom, put this up here. And this is the price at which the dealer sells. I think it's kind of like a car dealer, right? Car dealers buy at the low price and they sell at the high price. And the customer, which we said here, is going to sell at this price and buy at that price. So you will get the on your test an exhibit like I just got here. And in the exhibit, they'll give you very much what I've got here for you. And they'll ask, you know, like which of the following is true. And then you would have to come up with what of the transactions that are being offered to you make sense based on this exhibit. So for example, Chris, if you want to buy 900 shares, I don't have to do anything. I say, Chris, I'm not good for 900 shares at 16. I'm only good for 800 shares at 16. Or if you want to sell, if you want to buy 700 shares, well then, Chris, I'd have to fill you, right? Because 700 shares at 16 is within that quote. You know, that's called the size of my quote. If you want to sell, I'd have to be able to buy at least 1,000 shares from you. Right now, test question. If a market maker, a dealer, fails to honor a firm quote. So in other words, I am quoting this 15, 16, 10 by 8. And you say, Dean, we're buying 800 shares. I go, I don't think so. Change my mind. That is a prohibited practice and is known as, you know, it's called
Backing away.
Yeah, that's when I failed on my quote, right? And you say, Dean, are you backing away? I go, yeah, what are you going to do about it? He said, well, Dean, I'm going to call FINRA. Remember FINRA, the self-regulatory organization, Chris? They have a Department of Enforcement. That's not bueno, right? You know, like from the Department of Enforcement, they're, hey, Dean, we've had some reports from order entry firms that you're failing to honor your quotes. Why don't you come up here and explain yourself? Now, good news, Chris, the FINRA test point doesn't have a badge and a gun. They're just a club. So the worst thing is they can kick me out of the club, right?
Right.
So if they say, Dean, FINRA's on line 1, the SEC is on line 2. I'm picking up line 2. The SEC is not a self-regulatory organization. I'm picking up that. They go, you know who we are? I say, oh yeah, I know who you are. You guys got primary jurisdiction, interpretation, and enforcement of the domestic securities laws of the United States of America and can throw me in jail. I said, well, Dean, we're going to get along fine just as long as you remember that. No, I joke, most of them are attorneys and they don't really make as much as they'd make in private practice, but what they don't make in private practice, they get in power. Now I'm joking, for the SEC to throw you in jail, they have to go to the Department of Justice, right? So, you know, SPF, right? SPF is the guy at FTX who's in big trouble, right?
Yeah.
You know, at the end of the day, SEC is going to ask him to write a check. His bigger problem is the Department of Justice, right? Those are the guys who are, you know, going to try and throw him in jail. So, you know, I mean, I wouldn't want to be his attorney. You know, most attorneys say, keep your mouth shut. He's like, you know, crazy. All right. So we talked about the bid and the ask. We talked about You got to be careful on the buy and sell. Whose perspective? It's from the dealer market maker perspective. We're always on the confirm going to tell you in what capacity we acted. So, what's not on that confirmation to the Robinhood customer, for example, is who was the market maker. And so I call Robinhood, that's available upon request. And I call Robinhood and say, hey, I got my confirmation. It says you acted as my agent. So who was the other side of the trade? And they go Citadel. I go, okay, so Citadel was the market maker. And every time I call Robinhood, they say Citadel. I say, man, that's awful. What a coincidence. They said, well, Dean, we give all our order flow to Citadel. That's our preferred market maker. They're the only market maker we do business with. And they're going to disclose that they're receiving payment for order flow. Now, Chris, you're in no worse position because Citadel agrees to honor the inside quote, no matter what I'm displaying. So the inside quote is going to be the highest bid that we're looking at a screen and the lowest ask. That's called the inside quote or the lowest ask or inside market. Right. So there's more than one market maker. And so maybe somebody has a market maker in this security has a bid higher than mine. And so maybe they're quoting 1505, I'm quoting 15. So whoever has the highest bid has the inside quote. And I'm quoting 16 and everybody else is quoting like 1605, 1610. So I have the lowest asking price. And so that's called the inside quote or inside market. And I just told you that in my Robinhood example, their preferenced market maker agrees to always honor that inside quote, regardless of what they're displaying. Wouldn't think it's a big deal, but we're just talking about disclosures here, right? Now, if I'm Merrill Lynch, as I said, Merrill Lynch is a market maker. And so sometimes when you transactions in Merrill, your confirmation will indeed say, we acted in our dealer principal capacity. And that means here, you're going to buy it at the ask and pay no commission. So I say, Chris, one of the advantages of doing business directly with me, the market maker, is you pay the asking price, but you don't owe commission. And when you sell, you get the bid without the commission. Right? So that would be the advantage. We always disclose that. Now, we said there are 2 stock positions and 2 option positions you can have. So whether it's options or stock, you could be long or you could be short. Now, as it relates to options, there's one thing you definitely don't want to be naked on. I mean, if you're naked outside of the privacy of your own home, are good things or bad things likely to happen? Bad things. In fact, somebody might say, why don't you cover yourself? And so we're discussing options. The thing that we're worried about being short is short a call, because when you're short a call, you have an obligation to sell the stock. We're not concerned about somebody who shorts a put. I told you my client, for example, he shorted a 240 put, and I say, hey, Mark, so what you're obligating yourself to do is to buy that stock at 240. So the worst case is the stock is 0 and you're going to pay 240. And Mark, I already see that in your account, you have cash equal to the aggregate exercise price. In this case, 24 grand. It was 10 contracts, but 240, but our example 24. I go, not a problem. So short puts aren't a problem because it's a definable number. What's a problem is when you agree to sell stock you don't own. And so a naked or uncovered call is when you don't have the stock in the account. And the test question about that is it exposed customers to unlimited risk. So if I come into a brokerage firm and say, hey, I want to lose so much money, then you in advance can't tell me how much. You say, well, Dean, there's only a couple things that will do that. Short a call, a naked uncovered call, and short the stock, right? Because both of those are bearish transactions. And if you're a bear and it goes wrong, it goes up. And how far could a stock move against you on the upside?
Limited.
Yeah, because there's no ceiling, right? So the 2 things you should be aware of on the test that exposes customers to unlimited risk is short a naked call and short the stock. Both of those expose customers to unlimited risk. Now, quite substantially different. A covered call, you're covered, is where you agree to sell stock you own. And that's not a problem, right? You know, as a margin clerk, I don't worry about that at all because those stocks in your account. PS, don't ask me to send you the stock. I'll say, Chris, sorry, your stock is tied up right now in this covered call. Right. So long or short, we don't care about long, by the way, even on the option side, right? Again, there's only 3 or 4 option questions on your SIE, but we don't care about long options because you're paying a premium. You're just going to lose your money. By the way, it's not, that's bad, but it's definable. So, I always joke, Chris, wouldn't it be funny if you come to visit me in Vegas and it's like the casinos were like our business? I take, Chris, before I'm gonna let you go out there and gamble, I need you to look over this gambling disclosure document. This is all the bad things that can happen to you on the casino floor. It's 100+ pages. How much are you willing to lose in this particular visit? And, you would tell me 10 grand. I go, great. So here's $10,000 in chips and, don't be coming back to get more chips. I'm joking, but but it's easy to qualify somebody who's buying something, is it money they can afford to lose? So we're not too concerned about that. There are smartest things you can do as a bear, right? So I always joke, we don't want to be a dumb bear. And so what you might want to do on your short stock is enter a buy stop order to mitigate the risk, right? So I tell my broker, hey, why don't we put in a buy stop just in case this thing blows up on me? So that would protect that short stock position and mitigate, I shouldn't say protect, but mitigate the risk, so to speak. Again, to stop the loss on the short stock position. Another thing I could do is use an option transaction to protect it. I could do a long call. There's lots of things I could do. The main point on the SIE is just don't do something stupid. Don't do a naked call and don't short the stock unless you take other, risk mitigation strategies. All right. So investment returns. So if you are getting interest, what kind of an investment vehicle? This was from section 2 yesterday. If I'm telling you on the test, somebody's receiving interest, what kind of investment vehicle do they own if they're receiving interest?
Debt securities.
Yeah, right on, right? They have a corporate bond, or yesterday's session, or they have a government bond, or they have a muni bond. And remember, the corporate bond would be taxable. The interest you receive on a corporate bond would be taxable. The interest you receive on a muni bond would not be taxable. The interest you receive on a treasury bond would be taxable. If I'm telling you you're receiving a dividends, what investment vehicle would that be if I'm saying you're receiving dividends?
Stocks.
Yeah, it would be a common stock, a preferred stock. But just be a little careful because it could be dividends from a mutual fund, right? Because mutual funds, if it's a bond fund, it has interest, but gets paid to you as a dividend. Or if it's stocks in the mutual fund, that gets passed through to you as a dividend. So that could be a mutual fund as well, paying you a dividend. Now, you might say, in my example of the mutual fund, Chris, to the mutual fund that you don't need the money right now. So instead of sending it to you, you say just to reinvest in the fund. I said, well, Chris, that's great, but the IRS assumes you could have had the money, and that's the same as getting it. Right. So you're going to owe taxes whether or not you're receiving the dividends from a mutual fund. Now, that's assuming it's not your retirement plan. Right. It's in my personal account. And I say, hey, I don't need the money. Just go ahead and buy me some more mutual fund shares. The capital gains tax, Chris, is a transaction-based tax. And the easiest way not to pay it is not to transact. Right? So watching my securities go up in value is not taxable. What's taxable is if I then decide to do that. Fidelity bought 10% of Google at the IPO price of 85, and Fidelity still owns 10% of Google at the IPO price. Now they would decide when to sell the Google. And when they do, there's going to be a huge capital gains distribution to the Fidelity mutual fund shareholders, and there go taxes on it. Now, if it was in my personal account, I have 1,000 shares of Google that I bought at the IPO price of 85. That's $85,000. That position is now worth 10 million. I'm looking at it and go, woo, is looking at it taxable? No. I'm saying, maybe I should sell. but my tax mind says, you know what, if I sell that, I'm going to have a capital gain and I'm going to have to pay taxes on it. So we only pay taxes on realized gains. We don't pay taxes on unrealized gains. Now, the only two ways you can make money in an investment is the income stream and or the price appreciation. So if an investment has no income, then the only way you're going to make money is selling it to someone else for more than you paid for it, right? If it has income and potential, well, then that would be called total return. So what you're interested in getting a return on your capital through either the income stream from the investment and or the price appreciation in the investment. Now, when it comes to dividends, test question, there are two types of dividends corporations pay. They pay cash dividends and they pay stock dividends. So cash dividends are taxable. Cash dividends are taxable. Stock dividends are not. So I call you up and say, hey, Chris, just touching base with you. The company has declared a dividend. And you say, well, Dean, is it cash or stock? And the reason that's important is if I tell you it's cash, you're going to owe taxes on it. I say it's stock. And you say, ooh, what's the stock dividend? I go 10%. You say, oh, so I got 100 shares, so 10% more. I got 110. I go, yep. I go, but hey, Chris, don't get too excited. Everybody else has got 10% more. There's been no change in your proportionate ownership. And you say, well, Dean, do I have to do anything? I said, well, we're going to have to adjust our cost basis. You're going to have more shares at a lower price. More shares at a lower price. So in my example, let's say you originally bought 100 shares at 50. So your cost base there, cost basis is simply, Chris, the terminology for turning your money into an investment. Right? That's all that is in English, right? That's what, the idea here in investing is you're going to turn your money into the investment. And then at some future date, you're going to turn the investment back into money. And what you're hoping is that you have, more money, or more importantly, more purchasing power. So I said that's called our cost base here. And my example, I said there was a 10% stock dividend. And so we had 100 shares. We're going to times that by 10%. And we're going to get 10 additional shares. Now, did you catch what I said? Everybody is getting more shares. So there's been no effective change in your proportion ownership here. You have 10% more, so does everybody else. Now, what I would like to do, Chris, is tell the IRS that I bought the stock at $50 a share and I sold the stock at $50 a share. I don't owe any taxes. They go, no. Now, on your exam, you can shop your answer set. And a lot of times, without even doing any math, you can say, okay, I know the answer is more shares at a lower price. Right? So now I say we have 110 shares and we paid $5,000 for those shares. And so now we're just going to adjust our cost base accordingly. By the way, you won't have to do much math on your exam, but if you do have to do math, it's division. So if you can't remember what to do, divide. And if you can't remember what to divide, take the first number in the question, divide it by the second number in the question. That takes care of about 90% of the math. I'm mathematically challenged myself, so I'm going to use a calculator. Somebody offers me a calculator, I say, thank you very much. By the way, I'm pretty lazy when it comes to math, Chris. So I told you the first thing I'm going to do is just shop my answer set for something more than 100 shares at something less than 50. Maybe I get lucky. Maybe that's only one. I go, thank you so much. Usually that would be 50-50. There'd be two of them. So even that's helpful, though. I mean, I got 50-50, right? So I take 5,000. I divide by 110 and I get 45.45. That's what's called my adjusted cost base per share. My adjusted cost base per share. So cash dividend is taxable. Stock dividend is not. You don't have a right to receive a dividend. You only have a right to a dividend if declared by the board of directors. Here recently, Intel said to its shareholders, listen, guys, we are spending billions of dollars in capital expenditures. And we don't think it's prudent for us to continue to pay that dividend. And so we're cutting the dividend. We're not getting rid of it entirely, but we are going to cut it to 50 cents. And they said this dividend is going to be paid to shareholders as of record. So if you want to get this dividend, you have to be a shareholder as of record on the record date. And, this example, Intel says you're entitled to the dividend of 50 cents. If you are a shareholder as of record on Thursday, April 18th. That is a date that's set by the board of directors. Now, this is very important. In the secondary market, people are buying and selling the stock. And I told you that they made this change to their dividend policy. The board actually declared this dividend on March 1st. We don't care about the declared date. How long does it take for you to show up on a shareholder list? Well, regular way settlement says that it takes 2 business days for ownership to change hands. And so if I buy this stock on Wednesday, April 17th, I wouldn't be on the shareholder list on Thursday because it takes 2 days, right, to show up on that shareholder list. Now, kind of a coincidence here, or, something interesting. If I buy this stock, we're talking about whether I'm entitled to this Intel dividend. If I buy this stock on Tuesday, April 16th, T+1, T+2, I would be entitled to that dividend. Kind of interesting. If I buy that stock on Tuesday, I am entitled to the dividend. And if I buy it Wednesday, I am not. That is called the X date. X is Latin for without. I joke, do you have an ex-spouse? That means you're no longer trading with your wife attached. My best friend, his ex, she was, we're still friendly, but she goes, well, why did he tell you that? And he didn't tell me. I said, because I'm his best friend and you're his ex-spouse. Those are different relationships. If I say, what's the last date you were married? That's the day before your divorce, right? So this is called the X date. This is testable. So the X date, one thing that's testable is to know when is the X date. It's not a coincidence that the first date on which the stock no longer trades with a dividend attached is 1 business day prior to record. That's not a coincidence, right? Because I just told you it's not a coincidence because that's what the Uniform Practice Code says, right? The Uniform Practice Code standardizes practices within the securities industry. And I told you what the X date is. It's the first date, there's others, on which the stock no longer trades with the dividend attached. So my example of Intel, the stock should go down by that 50 cents because if Intel is worth X on Tuesday with that cash in the corporate shell, and then it's not going to have that cash in the corporate shell because it's being distributed to the shareholders, well, then we would expect it to go down by that amount. So first date on which the stock no longer trades with the dividend attached. So a couple recognition questions here. So let me get a different color here. Let's do there. Yeah, that's kind of.
This is also derp, right?
It's exactly what this is, right? So as you see here, I love that mnemonic advice. Let's just put that in big letters. That's deserving of a, 72 points font, right? There's our D. And we were talking about our E. Whoop. Now, what I don't have on here is your P and your, I'm going to put the E in a different color. I'll tell you why in just a second. The record, and you said derp, so that means we got a P, and the P is just when they're going to pay it. And as I said, we don't really care about the payable date either. We only really care about for test purposes, I mean. We care about the record and the X. So that's how that is in chronological order. The reason, Chris, I put the E in a different color is because that is not set by the board of directors. The Intel board chooses the declared date. They do the record date. They do the payable date. The X date is a function of secondary trading in the securities industry essentials, right? And that's a function of the Uniform Practice Code of FINRA. So the Uniform Practice Code standardizes practices within the securities industry. Now, let's say that my Intel example, Intel closes at 25 on Tuesday, and it's paying a 50-cent dividend. We would expect that stock to open up at 24.50, right? Because if it was worth 25 with the money in the shell, and now it's not in that corporate duration, it's being distributed to the shareholders. So we expect to go down. But now what if I call you, test question? I call you on Tuesday and I say, hey, Chris, if you buy it today, Tuesday, you get the dividend. But if you wait till Wednesday, no dividend for you. Am I a full service broker, or B, violating the code of conduct? You say, Dean, if I buy it on Tuesday, aren't I just creating an unnecessary tax situation? I mean, isn't the stock going to go down by the amount of the dividend? I go, well, you're no fun. And you say, Dean, can I talk to your manager? Selling dividends is a big no-no, and that's using this dividend date, X date, is an artifice, an artificial sense of urgency that doesn't exist. So one thing we agree in the securities industry we're not going to do is sell dividends. In other words, no, we're not going to try and confuse customers by thinking they got some, free lunch if they buy the Intel the day before the X. So, you should definitely know prohibited practice. We don't make yesterday's session. We don't make breakpoint sales. We don't sell dividends. We don't front. I always tease when I'm teaching Series 7. If you want to freak out your manager, go to your manager and say, I can't wait till I pass my 7 so I can do some churning and some front running and do some insider trading and sell some dividends, Those are all the things we don't do. Okay, so that's pretty testable. Let's see, yesterday worked on 33 questions in section 2, and now we're working on 23 sections in section 3. And we just talked about dividend payment dates. And then on bonds, the one to worry about on bonds is current yield. I wouldn't worry about the yield and maturity yield to call, except to know where they are in relationship to each other. You feeling pretty comfortable with your teeter-totter or seesaw about that relationship with bonds? Good.
Yeah, that's the most comfortable I feel with, to be honest.
Good. Okay, so cost basis requirement. So remember, the test point here is what you'd have sales proceeds, and the sales proceeds are going to be compared to your cost basis to decide whether you owe taxes. Right, so that's what that means by cost basis requirements, and I showed you how to adjust for a stock dividend. Settlements, very important. So the vast majority of things, corporates and munis, test question are T+2. So that's called regular way settlement under the Uniform Practice Code, very testable. Do you know the things that are T+1 that are goofy and are not T+2? I just told you all corporates and munis are T+2. So what test question settles T+1?
Options and govies.
Perfect. You nailed it. And exactly right. And then T, well, here in the content outline, when they say T, that just means same day. And so you can do cash settlement same day, wouldn't worry about it. There are securities that don't have physical certificates. Book entry means there is no physical certificates. This drives older clients nuts. Well, transfer and ship my certificate. I go, Chris, there is no certificate. The security is book entry. Now that's typical of treasury securities. So, you're confused if you buy like a treasury bond and say, Dean, transfer and ship my treasury bonds. I go, there is no such thing. The U.S. Treasury, Chris, has you on the books, book entry, and they'll send you the appropriate checks at the appropriate times. And a lot of muni bonds are book entry. So like state of California is book entry. California doesn't print bond certificates. They say, Chris, we have you on the books and we'll send you the appropriate checks at the appropriate time. And if you sell, transfer your ownership, we'll put that person's name on the books and send them the checks, right? So there's no certificate is the point. Stock splits, very testable. I showed you how to adjust for a stock dividend. And it's the same in a stock split. What I mean by that, same in a stock split, is a stock split is not taxable. But once again, you have to adjust your basis. And so, one thing we would want to do is, again, as a trick, just shop the answer set. And whatever number of shares they give me, say, okay, I need more shares at a lower price. But let's say tomorrow you get a 3-for-2 split. Do you know how to proceed in such a situation to figure out how many shares that is?
Yes.
A lot of different ways to do it. First thing, remember, is you just shop the answer. Maybe get lucky. There's only one that's up more than 100 shares at a lower cost base. The way I do it is I just take my calculator and I take 3, divide by 2, and then I just times it by the position, which was 100 shares. And I have now 150 shares. Right. So you're going to have to, I told you that there's only 2 or 3 math questions. Current yield, usually it's current yield tomorrow. It's, can you adjust for the stock split? That's pretty much it. Maybe a break even an option, but you can assign that to the universe. Reverse splits are embarrassing. How embarrassing it was. This General Electric stock went to $1. That's crazy bad. And, they said, let's do a 10-for-1 reverse. So now we go the opposite direction, right? So you got 100 shares of GE, now you got 10. I usually say it's bad because the point here is to get the stock price back up to a respectable number. So, Mr. Buffett wrote a nice editorial, I thought, about to, his progressive friends and my progressive friends about, buybacks are not evil. When a corporation, the board gets together again, Chris, in my Intel example, Intel decided they didn't have excess earnings to be distributing dividends. But, Mr. Buffett, as an allocator capital, says, listen, we have more money than we need to run Berkshire Hathaway. How can we return this to our shareholders? As an owner, I say, well, yeah, don't do something stupid with the money. If you don't have a good use for it, I would just, please send it out. Right? So that's a cash dividend. But another way we return capital is through a buyback. This is known as treasury stock. And this is where the corporation goes into either the open market. In other words, they just go into the open market and buy the stock, or they make, test question, a tender offer to their existing shareholders. Mr. Buffett, in his buyback, he said, listen, we have excess capital. And so I'm going to make a tender offer to our existing Berkshire Hathaway shareholders and see how many of them are really long-term and with us. He's kind of saying that if you accept his tender offer, that was proof that you shouldn't be with us for the long term because you would prefer the money than the stock. Now, as existing owners, we're going to like this, be on the SIE, but we're going to like it because our proportional ownership goes up, right? Because the share count is going down as the company's buying back the stock into the treasury. Now, whether this is a tender offer, test question, from the issuer, or whether it's a tender offer for someone else. So I'm a Twitter shareholder and Elon offers me $42 a share for my Twitter stock. That's a tender. Tender offers, test question, have to be open for 20 days. So you say, hey, Dean, I just got this offer from Elon to pay me $42 for my Twitter stock. And how long do I have to think about it? I said, well, that offer will be open for 20 days as a minimum. Right? Same thing with my Berkshire Hathaway. It'll be open for 20 days. And tender offer is just a fancy word for, hey, we are making you an offer to do whatever in exchange. Elon has been talking about the debt now he has at Twitter because he borrowed, 10 or 13 billion, I forget, billions to buy Twitter. And so he said the one thing he might do is offer to exchange the bonds for Twitter stock. So, I call you and say, hey, Chris, those Twitter bonds we got? You go, man, that interest rate is so high. I go, yeah, it really is. And, but there is a risk of default. I mean, I can't believe Elon's already talking about perhaps filing bankruptcy on Twitter. I mean, we just literally lent him this money, weeks ago, so, but anyways, here's the deal. He's willing to exchange you the common stock for the bonds. And you say, well, what's the deal? What's the exchange ratio, for example? But once again, the point is we have 20 days to decide, right? 20 days to decide. Now, one of the things you have as an existing owner is you have a right to maintain your proportionate ownership. You demonstrated your prowess in this yesterday. As you recall, I asked you about a rights offering. And I said, hey, Chris, if you have 1,000 shares, you have 1,000 rights, and you, with those rights, can buy X number of shares. I wouldn't get too much in the weeds on the SIE. If you come back for 7, it's a bigger deal. But remember, you have to be able to tell me on the test that you can distinguish between the rights and between warrants. And you yesterday told me you knew that rights were short-term, exercisable below Section 3. And you told me that you recognized yesterday that warrants are long-term and exercisable above. And woohoo. M&A is the same thing, right? These are just corporate actions. So it was an acquisition of Twitter that I walked you through. It could be a merger. Hey, I say, hey, Chris, company A and company B are merging. Here is the offer for company A and B. And now there's going to be some new entity, perhaps, you know, as we do the merger. And again, at just a point, you get to vote on this thing, and you get 20 days to do that. You don't have to be present at the meeting to vote. You can vote by proxy, right? So here it says impact of stock splits, reverse splits. We talked about that. Adjustments based on corporate actions like a stock dividend or stock split. We have to tell the customers about this. So 1934, you know, 33 and 34 were huge. President Roosevelt, all that legislation was called the New Deal. You know, that means the old deal must have sucked. You know, before 34, we would have shareholder meetings, Chris, at 11:59 p.m. Alcatraz Island. You had to be present to vote. And there'd be a thug on the dock, and he'd ask you how you're going to vote. And if you didn't come up with the right answer, then you didn't make it to the shareholder meeting. You know, so 34 says that shareholders do not have to attend the meeting to vote, that they can vote by proxy. Now, when you open an account at a brokerage firm, I say, Chris, you know, if you put your securities in street name, the name of my broker dealer, operation in life is going to be so much simpler in terms of transferring ownership and doing things backstage for you. In a margin account, Chris, you will have no choice. Your securities must be in street name, the name of the broker dealer. Now, what that means is a lot of this proxy material is not going to the shareholders. It's going to that broker dealer. And so that broker dealer, test point, is going to have to forward the proxies to those shareholders at no charge. So, you know, if I'm a Robinhood customer and I own the raw stock in my Robinhood account, then Robinhood's got to forward me that proxy material. Now, be careful. The broker dealer can charge the issuer to forward the proxy material, but just can't charge the customers, right? So proxy ability to vote without that. Now, the two basic types of accounts you have at a broker dealer are cash accounts where you intend to pay in full. Do you know some of the accounts that are mandatory cash accounts, meaning you can't use margin?
Yes, IRAs.
Retirement accounts. Well, I wouldn't worry about annuities as it applies to the test, but
Okay.
the one I would worry about is retirements, and boy, very testable. High probability. Uniform
Custodial?
Gift to Minors Act and Uniform Transfer to Minors Act.
Okay.
Custodial accounts must be cash accounts. You can't leverage up the kid. Say, hey, you know, I leveraged you up, didn't quite work out, something about a maintenance call. Right. So UTMAs, no margin in an UTMA. Make sure you know the kid's tax ID goes on that account. That's very testable. And it's one minor, one custodian per account. Now, if we're opening a margin account, there's going to be additional documentation required. So are you aware of the documentation to open a margin account?
I believe so. They give you a disclosure agreement?
The credit agreement where we tell you
Credit
you're
agreement.
borrowing money and you're paying interest. You know what you're paying interest based on what interest rate you are paying? Is it the prime rate? Is it broker call? Is it the discount rate? Is it the Fed funds rate?
I think it's the Fed funds rate.
It's broker call.
Okay.
So you're going to get an answer set. You know, we didn't get to go over a whole lot of things, you know, they're on the test. Obviously, we had, you know, this second session. But Chris, just be prepared for an answer set. A, discount rate. B, Fed funds rate. C, broker call, D, prime. And depending on the question will depend on your answer. If I ask you about which of those rates are set directly by the Fed, that would be the discount rate. And that's the rate the Fed charges member banks. Very testable, very high probability, Fed funds. That is the most volatile of the interest rates. It changes the most often is what that means. And that is banks with excess reserves lending to banks with deficient reserves. Broker call is banks to brokerage firms. So another piece of this agreement, Chris, is what's called the hypothecation agreement. That's where you tell me that you understand that you're borrowing money, you're pledging your securities as collateral for the loan. As we said, that means your securities are going to be in street name. And if you don't fulfill your responsibilities, we're going to sell you out. Now, what I do, don't get too in the weeds here, but I'm going to rehypothecate your securities to Mr. Banker. I'm going to say, Mr. Banker, here are Chris's securities. I'd like a loan for Chris. That's perfectly copacetic, using your securities to get you a loan. Not a problem. And then, Chris, whatever the bank charges me for that money, broker call, I'm going to charge you broker call plus. Depending on what kind of customer you are. We love lending customers money. You borrow a lot of money from us, we won't charge you so much. Right? The better the customer you are. Now, the third document, very testable, is not required. It is optional. So 1 and 2 is mandatory. 3 is optional. And that's called the loan consent form. And that's where we say, we have other customers who wish to sell securities short. Would it be okay, Chris, if I lend my customers your securities? And you say, well, Dean, I don't think it's in my best interest to help people go short securities I'm long. I said, well, Chris, it's not. And that's why this part of the document is what? Optional. So that's where we're getting the securities that people are selling short. So at the brokerage firm, we have what's called stock loan. And if I want to sell short some stock, I say, hey, I'd like to borrow stock. Key point. Whether I want to borrow stock or money, I need to have a margin account. All short sales must be conducted in a margin account. So whether you're borrowing money or stock, you need a margin account. I think we did a pretty good job talking about options. I think we did a pretty good job talking about discretionary versus non-discretionary. Now, if we're going to charge you a fee, so, broker dealers make money from transactions. For many, many years, Chris, this is how we made a living. I'm dating myself. I say, Chris, your relationship with me is free. As part of that relationship as your stockbroker, I'm going to sometimes suggest you buy or sell securities. And when you do so, there'll be a transaction. And my broker dealer will make money from either the markup or markdown, if we're a dealer principal, or the commission. And Chris, I get a portion of that. That's called my payout. That's how we did it for many, many years. And you say, well, Dean, I'm not comfortable with that. I said, well, what are you not comfortable with? You go, well, it seems like, you have an incentive to tell me to buy or sell something. And now in the old days, I would say, well, Chris, hopefully ethically, I'm not challenged on that. But, I say, well, Chris, did I tell you that not only am I registered as an agent of my broker dealer, I'm also an investment advisor representative. We have an affiliated investment advisory firm. And if you'd like, you can pay us a fee. So key point, if we're charging fees for assets under management, that is not a broker dealer. That is an investment advisory firm. Most of us do both. I'm not feeling sorry for Goldman Sachs, but they said poor Goldman Sachs, because unlike Morgan Stanley, which has a lot of wrap accounts, where they've had all these Morgan Stanley customers who are paying a fee that includes some transactions. They have wrap brochure that tells you what's in the fee, what's not. Goldman doesn't typically do that. They make money from transactions. And some years that's better than Morgan Stanley, but not lately, right? Are you going to get a 766? Are you getting a 663.65? Do you know where you're going after this SIE?
The 7 and then the 66.
So that means Chris, means you're going to be selling wrap accounts.
Yes.
So you
Correct.
say, hey, Dean, here's the brochure that tells you what's included in this wrap, the fee, how many transactions, how much research, here's what's excluded, whatever the case may be, right? So,
Yeah.
so you have to be duly registered on that. And then educational accounts, they like to ask you like the difference between Coverdale's and 529s, and just make sure you know that a 529 is the better deal. I'll leave it to you to, research. I'm just telling you that, on your test if they ask you, I would just tell you should say 529s because you can front load them. There's a lot of things you can do with them. You should definitely know how to register the accounts, whether it's joint tenants with rights of survivorship. Should definitely know that, right? The decedent share goes to the surviving party, whereas tenants in common, the decedent share goes to the estate or beneficiary. So make sure you know the distinctions between how to title that account. If we're going to have a corporate or institutional account, we're going to need additional documentation. And we're also going to need a trust account. We're going to need the trust agreement. I told you custodial accounts very testable. I told you need to know no margin, kid's tax ID number, one-on-one, one minor, one custodian per account. Okay, well, we got another quite a bit done in our second hour here today. Any other thing on your mind before we call it quits here?
If you do have time later on today, I like to just finish the whole thing. I'd obviously, I can pay you now if you want to continue, but you might have something going on.
Well, I as long as you feel comfortable, I'm not opposed to that. But I told you that my first thing is the Hippocratic Oath. So as long as you feel like you're moving forward and matriculating, that's fine. I don't want to do it if all of a sudden we're starting to go backwards and you're getting worked up about things. So why don't we
No, I'm not working backwards. Everything that you're talking about is just you and I having a one-on-one.
Yeah.
And there was obviously these firms don't really do that, so I kind of need someone to do that with me.
Yeah. So let's just let me check my schedule and let's plan on.
Yeah.
I think it's doable. So we'll try and reconvene later this afternoon. Are you completely open this afternoon, or is there something that doesn't work?
I am. I'm here till like 6.
Okay, so let me hang up and or get off the call, and then I'll send you an email and we'll figure out how to proceed.
Okay, sounds good.
And then to make sure too today though, we're kind of going against my normal thing I tell people, which is you should fold up your study plan noon of the day before your exam because you need to get some rest. So we want to make sure that you're still going to be well rested on your exam. We don't want you to be, we don't want to wear you out today when you need your energy tomorrow. So, but I'm not opposed to it. I'm just giving you a heads up or warning. We call that an options contrary exercise advice when somebody wants to do something contrary to what would be the best practice. But let's finish this call up. You can see what you can do to find that previous file.
I will.
I'm thinking about
3
o'clock. I'm going to look at my schedule. But I'm thinking 3. Where are you at again? Where time zone are you in?
I'm in California.
Oh, perfect. So we're both in Pacific time zone. Great. So let's shoot for about 3. And like I say, I'll follow up with if everything works out fine, I'll just send you the Zoom invite. If not, I'll just give you a call. But I think we can do it.
Okay. Sounds good, Dean. Appreciate your help.
You bet.
Thank you.
Talk to you later. Bye-bye.